Welcome or welcome back to part 4 of our Money Reset series. So let me guess, investing is something you want to understand. But every time you think about it, a little voice says, oh, what if I mess this up? What if I lose money? Or what if I'm not ready? These fears are the reason why so many smart and capable people avoid investing for years. But today that changes. Today you'll learn what investing actually is in simple human language, why you don't need to be an expert, and the 3 principles that make investing feel safe. By the end of this video, you'll understand the one thing that no one tells beginners. Investing isn't hard. Feeling scared of investing is what makes it hard. And we're about to fix that. A lot of people believe investing is only for high earners, finance bros, or people who have their life together. But that couldn't be further from the truth. Investing isn't just for rich people. Investing is how regular people become financially secure. And here's something most people don't realize. Investing only feels complicated because the finance world benefits from making it sound complicated. For decades, experts, fund managers, and institutions framed investing as something mysterious and technical because the more confused you felt, the more you would rely on them, their products, and their fees. But the truth is, you don't need a lot of money to begin. You don't need to know everything up front. You don't need to understand the entire stock market. You only need 2 things, time and a willingness to start small. That's it. Investing was never meant to be complicated. It was meant to be a long-term relationship between your present self and the future you're building. So let's strip away the jargon for a moment. Investing at its core is simply this: your money quietly working in the background while you live your life. No noise, no pressure, no complicated trades, and no need to stare at charts. Here's something most beginners don't realize. When all your money sits in cash, it slowly loses value over time because prices rise. That's inflation. Inflation simply means your money buys a little less every year. And to show you the impact, here's a dramatic historical example. During the Weimar Republic in Germany in the 1920s, inflation became so extreme that people used cash to light their fireplaces, because the money was worth less than the wood. Now, inflation today isn't like that, but the message is the same. If your money just sits still, its power slowly fades. That's why investing matters. It helps grow your money at a pace to keep up or often beat inflation. And that slow, steady growth, it becomes incredibly powerful over time. It's like planting a seed. At first, nothing seems to happen, but underground the roots are forming. Later in this video, I'll show you why these roots matter so much. But first, let me tell you a little personal story, because my first experience with investing did not look neat or confident. I still remember the first time I invested. I was in my 20s and I just had paid back part of my student loan. And for the first time in a long time, my finances felt stable enough to breathe a little. But I was scared and I was afraid of making a mistake. I also thought I needed to know everything before I even started. And honestly, it felt like it was something other people did. People who were smarter, richer, and more confident than me. But nothing changed until I tried something very simple. I invested a teeny tiny amount, an amount that was so small that it didn't scare me, like $50. That was the key for me. I wasn't trying to get rich overnight. I was just trying to build the habit, to prove to myself that I could start before I felt ready. And the moment I began, even with that tiny amount, everything started to make sense. Not because I suddenly became an expert, but because investing becomes clear as you do it. So if you've been waiting for the perfect moment, the perfect salary, or the perfect knowledge, this is your reminder. Start with an amount that feels comfortable for you, even tiny, and then let the habit grow long before the numbers do. There's a reason that you keep hearing that time is the most powerful factor in investing. It's not necessarily about how much money you invest. It's about how long your money has to grow. And to make this feel real, I want to show you a simple example. Let's take a look at Sarah. Sarah invests $100 into a basic stock market fund that grows about 8% per year on average. Nothing extreme, nothing fancy, just consistency. Now here's what happens over time. After 3 years, almost nothing. Her line is basically flat. And her initial investment of $3,600 hardly earned her any interest yet. This is the phase where you feel like you're putting money in and nothing is happening. But just wait for the 10-year mark. The line starts to curve slowly. She's now earning interest not only off her contributions, but of her contributions plus the accumulation of interest over the past months. And after 20 years, the line bends upward very quickly. This is compound interest in action. Within 20 years, her initial investment of $24,000 grew into $58,900. This is the reason why long-term investors talk about letting time do the heavy lifting. And Albert Einstein famously said, "He who understands it earns it. He who doesn't pays it." And honestly, when you see this curve, it makes sense. Now let's change the scenario and add a few factors. Imagine Sarah started at 20 and her friend Alex started at 30. Same $100 a month, same return, same everything. As you can see, Sarah's money grows more, simply because she gave her money more years. An easy way to understand this is a simple rule called the rule of 72. You take the number 72, divide it by your average return, and you get a rough estimate of how long it takes for your money to double. So at 8%, money doubles about every 9 years. Sarah just gets more doubling cycles than Alex. And that's it. That's the whole secret. But here's what I really want you to hear. Starting at 30 is not too late. Not even close. Compounding still works. It still grows. It still builds a future. And you can start with whatever amount feels comfortable for you. The best time to invest was maybe years ago, but the second best time is today. Now that you understand what investing really is and why time matters so much, let's bring everything together in the simplest way possible. Not strategic, not technical, just 3 principles that make investing feel calm, clear, and truly doable. The first one is invest consistently. The amount doesn't nearly matter as much as the rhythm. Investing $20 every month is better than waiting years to invest $2,000 or nothing at all. Consistency builds the habit, and the habit builds the future. You don't need to get it perfect. You just need to start in a way that feels comfortable for you, and let consistency take it from there. The second one is let time do the heavy lifting. Your investments don't need constant attention. They don't need to be checked every day. They grow quietly, the same way seeds do. And long-term market studies keep confirming this. There's an analysis that I really love. It looked at what happens when people try to time the market versus simply staying invested. If you had missed just the 10 best days in the market over 30 years, your returns would have been cut in half. Half, imagine. And you would even need to invest more time and energy to even get these results, if you would even get them. In other words, trying to be perfect hurts your returns even more than being patient. You don't need to predict anything. You just need to show up patiently and steadily and let time work in your favor. And third, diversify. Diversification protects you. It makes sure that your money doesn't depend on the success of just one company, one idea, one industry, or one moment in time. Because even great companies can struggle. Even strong markets can dip. And no one, and not even experts, can predict which companies will shine and which won't. Diversification is how you spread that risk. It's what keeps your future from resting at a single point of failure. And the easiest way for beginners to diversify without having to pick individual companies is through something called an ETF, Exchange Traded Fund. ETF just means instead of buying one stock of a company, you're buying a whole group of them at once. It's simple, it's low maintenance, and it takes lots of pressure off your shoulders. And if it's still a little bit confusing for you, here's the explanation that made ETFs finally click for me. And it stuck because I love electronic festivals. Buying one company stock is like buying a ticket to see one artist at a concert. If the artist cancels, your entire day is kind of ruined. But buying an ETF is like getting a festival ticket that lets you see every artist across all stages. If one artist drops out, the festival still goes on, and you will definitely still have a great day. If one company dips, the ETF still holds dozens, if not even hundreds, of others performing right alongside it. And the best part about these 3 principles, they're timeless, they're simple, and they're honestly enough. Because investing was never supposed to feel like a full-time job. It was supposed to support your life, not consume it. If you haven't watched the previous videos of our Money Reset series yet, I have linked them up here. So see you next week for our final video. Bye!